Appreciate everybody that's joining. My name is Michael Guy. I'm a member of the ETF think tank at Tidal Financial Group. Tidal Financial Group is an RIA. Our primary business is to be a white label ETF issuer, meaning that we bring funds to market. We touch a lot of different parts of the ETF industry, and we work with a lot of financial advisors and a lot of thought leaders like Mr. Lawrence Lepard here. So hopefully this will be a good conversation with my colleagues and Mr. Lepard. And I promise that this will be more than a worthwhile conversation. So please, everybody that's watching, listening, and seeing this on YouTube, make sure you hit that subscribe button for the ETF think tank. Let's have everybody introduce ourselves on the title side first before we get into Lawrence's background and why everything looks perfect in the future. Mr. Weisskopf, go ahead. Mr. Weisskopf is not there. Mr. Good, Cynthia. I think we're having. I'll message Weisskopf. Go ahead, Cynthia.
No worries, everybody. Hi, everybody. I'm Cynthia Murphy. I am head of research for the ETF think tank. I help run content that we put together, and I'm very excited to be here. Jacansky, you want to go next?
Absolutely. David Jacansky here, fellow portfolio manager within the Tidal Financial Group, focusing on Hoover ETFs and RSMAs, and I'm terrified to be here to learn all the things that we're going to learn. So,
and all you, Lawrence, tell everybody about your background.
Yeah, so I'm Lawrence Lepard. I run a fund called Equity Management Associates, a private investment fund, partnership, long-term outlook, and also run some RIA sleeves, a number of them, and directed accounts. So I focused on sound money for most of my career. Well, actually post-2008. I was radicalized for sound money during the great financial crisis. So that's the theme of kind of investing that I do.
Looks like Mr. Weisskopf is back. So hopefully it's not just sound money, but sound internet connection. Go ahead, Dan.
You're asking me who I am.
Yes, go ahead. Yes.
So Dan Weisskopf here, the ETF professor, also portfolio manager of Block and lead ETF strategist for the ETF think tank.
All right, so I'm going to start off, and we're going to go back and forth with you, Lawrence. But I know you had liked that post I put out. I said, gold is not just an investment, it's a warning. I want to hear your thoughts on gold in the context of the strong dollar, which I thought was supposed to be bad for gold.
Yeah, it's a great point. I mean, I think what's going on right now, what's very interesting to me right now in the marketplace is that gold has held in very well. It's within 4 or 5% of its all-time high, which it's bumped up against a number of times. And yet we've got, interest rates up from 0 to 5.25. And, we've got a set of conditions that should be very hostile to gold. And yet gold is doing well. And in my opinion, is close to breaking out. I think the reason for that is that gold is very good at looking around the corner. It always has been. It did it in 08, it did it in 16, it did it in 18. And it tends to see financial trouble before it arrives. And I think financial trouble is on the near horizon, and gold smells it. And so, to me, that's why we got a bid in gold in spite of a major increase in real rates.
I will say that's been one of the more interesting narratives that got countered, because the narrative has always been gold needs negative real rates.
Correct.
It turns out that's really not the case at all.
Well, they do correlate a lot. If you go and look at charts correlating the two, they have correlated in the past over time. So it's not entirely untrue. But, the other thing about what real rate, right? I mean, are the inflation numbers accurate? I mean, not to go deep conspiracy, but, we all know that there's a pretty good argument that maybe the inflation isn't being accurately counted. So they may still arguably be negative. And I think that's what gold smells. Gold smells the fact that given the monetary constellation that we have right now, the odds of future debasement are extremely high. And that's kind of how I read what's going on in the market.
I'm sure Weisskopf is going to jump in here and ask about Bitcoin because that's his expertise, but I'll just jump the gun. In the context of debasement, how do you see crypto assets and Bitcoin playing into that?
Yeah, let me right up front separate the two. I hate all crypto assets, including Ethereum. I'm a maxi. I'm a Bitcoin maxi. I think every other crypto asset is a shitcoin, including Ethereum. So Bitcoin to me is an incredible technical innovation. It, I believe, is a sounder and better form of money than gold and will win longer term. But gold's not out yet. Gold's not done. And I manage a fund that has both in it. I believe actually Bitcoin is doing the same thing as gold. It's interesting. This happened in 2020 as well. gold moved first and Bitcoin followed. Bitcoin went much further, and probably this time will as well. But gold started moving a few months ago, and Bitcoin didn't catch that bid up to 35 until more recently. So to me, they're both the same trade, which is to say, it's really ironic because a lot of people thought Bitcoin was just a proxy on the triple Qs, it was a risk-on asset. I think Bitcoin, as amazingly Fink said, I think Bitcoin is actually going to become a safe haven asset, which is really kind of hilarious when you consider that something's gone down 70% at various points in time. But
well, in fairness, Treasury's pretty much did that. So until it's 2 years, never.
Well, that's true. Yeah, the Treasuries are down 50% too, and they were a safe haven asset for 100 years, or 80 years. But yeah.
Yeah, I think the peak to trough on 30-year Treasuries was right around 60%, which was like a little bit worse than the 08-09 equity drawdown, which is pretty insane if you think about it in that context.
It's incredibly insane. I mean, the world is, as Michael says, we are effed. I mean, it's a messed up world financially, and I will just say it doesn't really surprise me because when we went to me, the big crime here, the big problem we got into here. When we went to 0% interest rates post-2008, that's what radicalized me. I mean, the QE and that. I mean, that's just a crime against nature. I mean, the interest rate is supposed to set the risk-free rate or the rate at which capital gets allocated between savers and investors. And when you go to zero, it's just like a crime against capitalism. It makes no sense. You can't have any efficiency. If money is free, then is money really free? I mean, we just get handed out. And so when they did that, and they didn't just do it for a brief period of time. I was talking with somebody else about it today. I said, if they'd done it for a brief period of time and backed off, okay, fine. We had a crisis. We got to go to, I mean, they were saying the ATMs aren't going to work if we don't do this. All right, fine. So we got this crisis. Go to ZIRP, right? But they did it for 8 years. I mean, and then they came out of it. And then they went back into it again twice, and then they did it in size again in 2020. I mean, it's just like, and, you just, people don't understand that economies and economic transactions, there's linkage here. And so that when you do those kinds of things, you set in motion an entire series of events that are just extremely unprecedented. And that's why Michael's "we are effed" makes sense. I mean, it's just, we live in, hell, even Jerome Powell said it. The guy's an idiot. I'm walking around in a cloudy sky navigating with a sextant. I mean, what the fuck, right? I mean, it's just, it's really, to me, that's the fundamental problem. And as I've said in many podcasts for many years, the Fed is like a bunch of guys driving a clown car on an icy road where the steering's defective, and one guardrail is massive inflation and the other guardrail is massive deflation. And they're just bouncing off the guardrails. Okay, it's all transitory. We're good. Don't worry about it. We're going to be buying all these gubby housing bonds, in late 2021 when the housing market, when rents and housing prices are going up 20% a year. It's all good. We got this. Don't worry about it. It's transitory. Oh no, shit. Inflation's, 9%, 10%. Rents and housing are going, we got to slam on the brakes. We got to, and we're not even thinking about raising rates. And then suddenly they go from 0 to 5.25, nearly as quickly as Volcker did. So it's so messed up. And sad, really, because it's causing a lot of people a lot of pain. And that's the part that angers me. And that's, my Twitter persona is, I'm old guy yells at Fed, right? Because I just think these guys have really done us all wrong.
So Lawrence, I'm the guy in the room who's studied the Bitcoin miners.
Yep.
And I definitely see parallels between the Bitcoin miners and gold miners.
Yes,
right?
Very much.
What are your thoughts on the Bitcoin miners particularly? Because I have to tell you, I really struggle with their business model in many different ways, but I gotta own them.
Yeah, it's kind of like the gold miners. I mean, the bottom line is they're both kind of shitty businesses. Okay, I mean, if you kind of consider general business, study business. I mean, what you want SaaS business. You want recurring revenue and low cost, right? These are both very high CapEx businesses. And in the case of the gold miners, you got to continually find new stuff and build new mines. In the case of the Bitcoin miners, that equipment is always becoming more and more obsolete, and there's always more hash being added. However, as Saylor points out, when you get a bull market where the price of Bitcoin is going up much faster than the underlying cost of the electricity, or in the gold case where the price of gold is going up faster than your labor cost, your margins can absolutely explode. So they're both kind of incredible boom bust kind of businesses. And For the uninitiated investor, I would say just stay away. They're both pretty good ways to lose a lot of money. You got to get a lot of things right to make money. Maybe I'm a little crazy because I've been in the gold miners for a while now, and I've seen both sides of it. I've made a lot of money and I've lost a lot of money. So, and through that experience, I've learned that, there's a time to be in them, and then when you're in them, there are good ones that you want to be in, but there's a time to not be in them, and because they can destroy capital very, very quickly. So I completely agree with your view that Dan, that they're tough businesses, and we own a couple of them, but in the case of the Bitcoin miners, in my view, the defining characteristic of a Bitcoin miner is the long-term price of electricity. It's a commodity business. You just got to have cheap electricity. So we've got a couple of private companies with 1 and 2 cent electrical cost in our fund, and they're mining Bitcoin at $4,000 or $5,000 a coin. Okay, that gives you a lot of cushion. But some of the bigger ones that are taking on a ton of leverage and that have higher costs, oh boy. I mean, you got to get it. You got to get it right.
Just as a follow-up to Bitcoin as a flight to safety, in many currencies around the world, actually, Bitcoin has now reached new highs. It's just against the dollar, obviously, that we're still struggling at like a 50% loss. So for many of the people out there, you have to look at the global perspective. It is very much like back in the highlight of its best days of protecting your purchasing power in the future. You mentioned briefly tips before and the calculation of CPI. Is tips an asset you would also consider, just given the real yield that we've seen on them touching 2.5%?
Look, it's better than a regular bond, and it's better than some other choices. I'm not anti-tip. I'm not wild about it because of the government inflation calculation being so wrong and so crooked. Back to your point about the Bitcoin being high in a lot of currencies, same is true of gold. Gold is at a new all-time high in nearly every currency except for the US dollar. So the rest of the world, look, Brent's right. I mean, the dollar is the milkshake, and it'll be the last to go probably. Although, well, I'm not sure about that. But right now, anyway, there's a dollar short squeeze on because Powell's pushed these rates up and they're not growing the balance sheet. And so as a result of that, you're seeing all these other currencies suffer more than we're suffering.
You had used that term efficiency.
Yeah.
Right. Which is interesting because I don't know if we want to see what efficiency looks like with 8 years of ZIRP and QE, because the implication there would be, well, if all these companies survived off of that cheap liquidity, they ain't going to survive now. Right. So
I think that's right. And that goes back to your tagline on Twitter. I mean, we were saying this a little before the show started. I mean, I think one of the mistakes I think a lot of investors are making today, and of course, as an investor, doing this, I'm 66, I've been doing my whole career. What I've always learned, you want to look for the deviant perception, the perception that's wrong. And the perception that I see that I think is most commonly wrong, a couple of them that I see in the market right now that I think are most commonly wrong, are that we're going back to a deflationary world. I mean, we had 40 years of deflation. We reached peak deflation in March of 2020 when the 10-year hit, 60 bips for a few minutes. And we're now in an inflationary cycle. This is going to be the 70s on steroids. I think the other thing that people are doing is they're looking at too narrow a lens. I look at a lot of people, they've only been in this market since 08. And since 08, the right move has always been to buy the dip. And the market is generally out to screw as many people as it possibly can. And I think a large number of people actually really believe that you just can't go wrong. I talk to tons of my neighbors and friends and people I work out with at my gym, and they all, they're buying the dip. And, and it's worked. So I can't, right now they're saying, hey, Larry, you've been wrong. But I got to tell you, if you take a 100-year perspective, and if you look at just how big the bubble was in December of 2021, I mean, I thought we were in a crack-up boom. I mean, everything was going straight friggin' up. And, and if you look at any of the valuation metrics, you look at any of the stuff, that's done by Jeremy Grantham or John Hussman, you realize that we were more overvalued than we were in 1929. So as I kind of look at the market right now, the stock market right now, I kind of compare it to 1929. And so we had a 22%, 20 some odd percent down year last year. We bounced back this year and everybody's feeling pretty good about it. Boy, I don't know. I don't. I mean, you're at peak profit margins, peak PE multiples, the economy rolling over, all kinds of recession indicators. The yield curve was inverted, they're becoming less so, and of course that's a bad sign. And so to me, there's a lot of downside in the stock market. I mean, a lot. And I don't think the average person has really factored that into their thinking. And by the way, it tends to compound because I think, we've become a financialized economy. And we were just doing a thought experiment. I was with some other guys today talking investments. We did a thought experiment. Imagine if the stock market went down 50% from here. Imagine what that would imply for everybody's savings. And I mean, wouldn't you cut back? I mean, wouldn't you think, no matter what age you were, wouldn't you say to yourself, oh my God, I'm half as rich as I thought I was? What if your house price started to go down? So what if, even though you're not highly leveraged, what if both those, and then what if your neighbor lost his job and you thought, gee, the demand in my industry is not that great. I might lose my job too. And people forget about, in a fractional reserve system, the way the money multiplier works on the way up and it works in reverse on the way down. And that's how you got, the NASDAQ lost 80% of its value coming off the 2000 peak. I mean, I was in it. I know what it was all about. I was short it. I'd been long in it going up to it. The Dow lost 80% of its value coming out of 1929. This bubble was of the same magnitude as those two bubbles, and it's been popped. So look, I mean, there's no question the Fed will pivot and it'll come in with a lot of money, and everyone thinks that the Fed put will save the day. I don't buy it. I'll take the under. I don't think the Fed put does save the day. I think the stock market's going to be down 50% in 2 years from here. And the implications of that are, I don't think the average person is thinking about that. Now, can I guarantee that? No. I mean, this is all probabilities. I mean, there's nothing for certain in the investment world, as you guys know. And I'm always just kind of trying to, I'm playing it like poker. I'm just reading the odds. But I would give it a 60 or 70% chance that that's the outcome. I think there's some chance that the Fed pivots pretty quickly, blows a lot of money into it, and we don't get that big a dip. We get a 20 or 30% dip, and then we go up again, or muddle around for a while. But that's kind of the best case. And to me, the best case is we kind of look like the 70s, where, and I was a kid or teenager in the 70s. I mean, the stock market went up, went down, went up, went down. The stock market kind of treaded water. Bonds got completely shredded. My parents' house that they bought for $40,000 in the 60s became worth $400,000 in the early 80s. So it did a 10-bagger. And gold and silver went up, gold and silver mining companies and producing companies went up 30% a year for 10 years, in part because of the oil embargo by the Arabs. But the point is, I see us in a 1970s-like world, and I don't think that narrative is out there. I don't think many people are thinking about it in that way. So that, to me, is kind of the deviant perception right now that I think will suit people well going forward.
You mentioned some really interesting recession indicators there. One was like the 210, and also the reversion of the 210, which I think a lot of people are talking about now, is like the moment of unwind. Right. So that's some like juice left in the Treasury Fed end of the curve to then protect going forward, and also the magical 0.5% increase in unemployment rate that we're now at the 3.9 level. What else are you looking at on a shorter term basis for?
Go to my Twitter feed. I've tweeted some stuff. I mean, there's just a lot of I don't do that much original work just because I don't have that much time. My day is spent analyzing companies and stocks. I mean, really, I'm not a macro guy. I'm a stock picker and always have been. But obviously, the theme of my fund has always been, get the macro right, get a macro tailwind, and then pick the best names within the macro. So I spend my day looking at companies and stocks, but I spend my Twitter time fishing for macro stuff. And if you go through my last week's worth of tweets, you'll see, and I don't have them right in front of me, but you'll see just a ton of charts that show deterioration in housing, linerboard. Even one of the guys I was talking to today said that we've got a Bloomberg terminal. Well, I have one because they're very expensive. My partner has it, but TSA boardings have been going down. Just a lot. There are a lot of indicators that, to me, would suggest that the market's really starting to roll over. The credit card interest is really starting to bite. Defaults on cars, late payments on car loans. I mean, you're seeing it, and look, it takes a while, right? I mean, it's a lot of people, and to be fair, I was saying this 6 months, 9 months ago, so I was way early and way wrong. Okay, but just because it hasn't happened yet doesn't mean it won't happen. And in my view, it's coming, and rather sadly so, because I don't want to see anybody get hurt. I don't want to see anybody lose money, and I don't want to see this economy of this country go in the direction that I fear it might be going in. But the fact of the matter is, the job I'm paid to do is to try and protect capital and grow capital. And so, you've got to look at the facts and make decisions based on the facts.
So Lawrence, you and I are old enough to remember, unfortunately, 1987.
Real well.
Market.
That was it. Yeah.
Yeah. Where the market all of a sudden was down 30% in a day.
Yeah. Portfolio insurance, as you know, drove that. But go ahead. Yeah.
Going back to then, what were you doing and what were you thinking when that moment occurred? Because I went into my boss's office and I just said, what exactly is happening? And he was in his 80s at the time, and he just calmly said, it too shall pass. But by the way, bring the 100 venture capital files that we have into the office here with me so we can write 90% of them down to zero.
Wow. Yeah, I was at the time, I was actually a venture capitalist. I was at a venture capital firm. I was like a vice president, and we were making investments in small private companies, mostly technology oriented. In my personal account, I was short that day, and I covered it for a pretty nice gain. But the dollar figures were small. I actually thought it was the start of something pretty bad. What I didn't realize was that's what led to the setting up of the president's working group on financial markets, otherwise known as the Plunge Protection Team. And Alan Greenspan stepped in and said a lot of calming words, as you'll recall, and kind of got things going again. And, that was, to me, I thought it was more serious than it turned out to be. But it took a little while to recover from that. But as you'll probably recall back then, I mean, just to give you a sense, Dan, and others of the time and how different. So I entered the business I got out of business school in 83, entered the business immediately. And I recall at the time, we'd just come off a decade of inflation. And I recall at the time that the consensus view was that inflation was going to last forever. Oil and gold and gas stocks were the best stocks to own for sure, because they'd worked so well for 10 or 15 years. Technology was really risky and kind of stupid, especially software. Software it reminded me, it was like Bitcoin. Software, what is it? You can't even touch it. It's vapor, it's code, it's written on paper. How can software have any value whatsoever? I remember my boss saying to me, even though we were in the venture business, we were investing in bigger, technology companies, but it's like, these PCs, Larry, they're a toy. Nobody's ever going to use these. I mean, this is like an IBM Selectric. I mean, what else could you use it for? Yeah, it's got word processing, but I don't give a shit. And I recall buying Microsoft at the IPO. I can't remember what year it was, but I bought it at 13 times trailing, and it was growing 40% a year. Do you know what I mean? And people were like, "You're buying software? What are you, nuts?" So I mean, that was how negative. And as you recall, in the '79, there was that newspaper cover, "The Death of Equities," Business Week, and equities just sucked back then. So and meanwhile, there were smart guys like Gary Schilling who were buying a 30-year strip, bond, who basically made their own personal fortune by locking in a 14% yield on a 30-year bond, right? And so, and it just as, and he was saying deflation's about to emerge. And so I'm hoping that I'm today's Gary Schilling by betting heavily that I think, look, folks, I just think we're going to have an inflationary decade. I just see it so clearly. And I think, and it might be shockingly inflationary is my view. So, but I if you go out and if you got on Bloomberg and you look at the 5x5 futures on the interest rates, you'd see that right now they're 2.7. So, the derivatives guys are saying, in 5 years, inflation will be 2.7 for the next 5 years. I think that's woefully low. There's just no way. But it just goes to show you how these cycles run. And 40 years of deflation have trained people to expect deflation. And to be fair, there are a lot of deflationary things in the world, as Jeff Booth points out. I mean, I know, Michael, you're interested in his stuff. I mean, technology is very deflationary. And, but we had some other things that aren't necessarily going to continue to occur. We had the China price, which helped a lot, a billion people coming into the marketplace in terms of working cheaply. We also found, 10 million barrels a day of shale oil coming out of the U.S., which we didn't really know was there, this last decade. So there were a lot of tailwinds that we had that, in my view, are kind of going away, because what I read is that we're getting close to the peak on the shale. And I think there's starting to be more wage pressure in China. And so, I just see an inflationary world going forward.
So there's an audience member who's watching who noted your work at Continental Illinois.
Yeah.
And he said, can you please ask which institutions most resemble continental Illinois today?
Bank of America. Yeah, in my view. Yeah, that was a fun experience. That was my first job out of college or out of business school. I was in their venture capital group. I had a really good friend who was in their treasury group. We used to meet for lunch. I recall very clearly meeting with him one day, and he said, Larry, nobody's buying our shit. Nobody's buying our paper. I was like, what are you talking about? He says, nobody wants it. This Penn Squared thing is a friggin' disaster. And I mean, like 2 weeks later, the bank was gone. It was in receivership, and they brought in a tool and die guy to run it. And I mean, that was actually a case of where the federal government, they exacted penalties. I mean, the shareholders did get wiped out. They put in new management. I mean, this wasn't a 2008 deal. This was actually kind of a, we're going to be fiscally and financially responsible kind of deal. But yeah, and by the way, notice that happened in 83. Well, why? Because the Continental Illinois Bank went out and loaned the shit out of all the oil producers in the 70s, right? I mean, it was the easy trade, right? You couldn't lose money. I mean, it's like the Supertramp song, I mean, can we have kippers for breakfast? Yeah. Got to have them in Texas because everyone's a millionaire. That came out right around the same time. I mean, I recall it quite well. The Texas people were really, really rich in the 70s. And because we had an enormous oil boom, and the Continental Bank lent into it, and it blew up the bank. So, I mean, this story is as old as time, right? I mean, it just, success leads to more success, leads to excess, and then it blows up. And, and what we've got now, I mean, so we had the dot-com bubble that blew up. We had the housing bubble that blew up. We've now elevated to the sovereign debt bubble, and that's blowing up. And, there's no Deutsche Maschine. There's no, Martians aren't going to come save us, right? So the next, as this thing blows up, the currency is at risk. And, I mean, that's why it's obviously a sovereign debt crisis, and the sooner we recognize it, the better.
The Martians want to buy some debt, though.
They might. Yeah, they might. I mean, it's hard to say how it all unfolds, though. It's even with a clarity, I believe that even with some clarity as to what's going on, it's goddamn tough to navigate it because, you get daily swings back and forth, and you get year-to-year swings back and forth. I mean, you thought, okay, it's a no-brainer. I'll just go buy Bitcoin at 65,000, and then, bam, you get a 70% drawdown. And of course, the right thing to do is the dollar cost average, and to keep averaging into it because it's a good long-term asset. But sadly, if you're just if you don't really know how this game works, you might be inclined to sell it when it's down that much, right?
For those that are watching, just a reminder, please make sure you click that subscribe button on the channel, and make sure you also follow Lawrence Lepard on X. By the way, that point about 50% decline, like, that sounds really extreme, and that's like somebody would say, oh, you're the doomer, right?
Yeah.
But in fairness, it's like, all right, so we've had plenty of lost decades. If you believe that there's going to be high inflation, certainly on a real return basis, you could be sideways on the S&P, and on a real return basis, still be pretty close to 50%. So I don't think it's that outrageous, right?
Yeah. It really bothers me when people call me a doomer, because I'm not.
I'd be throwing on. I'm with you on that.
I mean, I'm really quite a big optimist, and I'm quite a bull on humanity and on the future of the world. I mean, we've made enormous progress. We're going to continue to make enormous progress. It's going to be really, really great. But that doesn't suggest that you shouldn't. You see a storm coming. I mean, you don't go stand out in the middle of a hurricane. Do you know what I mean? You batten shit down and you hide. You get ready to ride the storm out. And these guys, this is, as I alluded to earlier, this 0% interest rate shit. I mean, they've created a really big storm here. I mean, this is not something to be taken lightly. You can't puff all these. I mean, we don't know what the correct real price of anything is. We really don't. I mean, if a Bored Ape is worth $1.5 million, and a house, in Naples, Florida, on the water is worth $40 million. And, I don't know, I saw a Mercedes-Benz G-Wagon the other day, the sticker price was like 300 grand. I mean, I was just like, what the fuck? I mean, this stuff, it's nuts. It's absolutely nuts. I mean, we've got prices that are completely detached from economic reality, as best I can see it, in some areas.
So, we went through a crisis recently with the regional banks.
Yeah.
And my sense is they're probably still vulnerable.
Absolutely.
Obviously, there are concerns, to your point, about real estate, right?
Yeah.
My question is, at what point are some of these banks responsible for some of their mistakes? Because I was surprised with how generous the government was bailing out.
Well, yeah, I mean, great point. I mean, look, black letter law, Dodd-Frank said, everyone got, look, in my view, what happened in 2008 was an enormous crime. It was an enormous crime against the middle class of this country. The fact that the bankers who had blown that bubble got fully bailed out and became, billionaires as a result of those bailouts, it's just wrong. And I think everybody knows it's wrong. And that's why Dodd-Frank was enacted, so that would never happen again. And Dodd-Frank said that in the future, if banks fail, they will be put into a condition where the depositors will have to take a haircut. So Silicon Valley Bank failed. They made the wrong bet, on long-term bonds, and they got underwater. The depositors should have taken a haircut. Problem is the depositors were very well-connected, people in Silicon Valley and venture capitalists and, famous actors and actresses and even, billionaires in New York like Ackman, who said, if you do this, you're going to crater the entire banking system. And they terrified the living shit out of everybody and said, we don't really have capitalism here. We have rugged capitalism when it works. We have capitalism when it works for us, the rich people. When it really gets tough, it's socialism for us and capitalism for the rest of you guys. And, we're going to, because all these banks would fail and that would cause a ton of trouble, we're going to bail them out. And that's the fundamental problem that we're talking about here, folks. When we created the Federal Reserve as the lender of last resort, you basically gave somebody a political weapon to let the people at the top benefit themselves at the expense of everybody else. Period. Full stop. It's a money cartel. And so that's why the rich get richer, and that's why the working people and the taxpayers get screwed every single time. They change the rules. And so we got to end the Fed, and we got to return to sound money. And as I've said plenty of times, said it ad nauseum, fix the money, fix the world. I mean, you just can't have a fair society with a system that benefits these crooked people. You just can't.
Why self owe you? Because I know you're a big sound money guy yourself.
Well,
go ahead.
No, Lawrence, I guess my question would be regarding regulation, right? Are we at this point in the U.S. where we're hurting ourselves with so much regulation that's kind of hampering innovation?
Oh, I don't know. I haven't thought about that one much. I mean, sadly, it's like yes and no. Yeah, we are, because look, you wouldn't believe the hoops I have to jump to be an RIA and manage a fund and keep the SEC happy. I mean, I'm sure, Michael, you have to do the same things, right? You guys have to do the same things. And yet, we're all screaming at the top of our lungs, hey, Sam Bankman, free. I mean, this he's a fraud. He's a complete fraud. This is a Ponzi scheme. I mean, there were a lot of us in the Bitcoin community sending emails to the SEC saying, look at this video. He's talking about a box, and he's describing a Ponzi scheme. Why don't you guys do something? Because we knew it was hurting the area. Man, they're just, Gensler's just totally asleep at the switch. And I mean, I know lots of people who had hundreds of thousands of dollars in that system. They just got wiped out. Just totally rugged. I mean, if one of the most obvious frauds in the world isn't detected, I mean, Gensler should have been fired over that. I mean, it was one of the most obvious frauds in the world. The SEC didn't figure it out. I mean, WTF? So I don't know. I mean, back to your question. I mean, or Dan, back to your question. I mean, I don't know. It's the government in and of itself is broken in so many ways. I don't even know where to start. So, I don't know if it's more regulation, I don't know if it's the right people running it, whatever it might be. I mean, you're going to get the money out of it. I mean, how do these people go to Washington and become filthy rich? We know it's broken. And my contention, this goes to the Fourth Turning book, which we've talked about in the past, I think, is that, the only way it's what von Hayek said, the only way we're really going to solve this is just to have the money burned down. And then we're going to have to reset everything. And hopefully in a much, we'll go back to the founding principles that this country was created around. I mean, the founding documents of this country are fantastic, but you'll also notice one of the founding documents of the Constitution says only gold and silver will be money. And, we've gone a long ways away from those founding documents in terms of the way we run the place now. And we got to go back to the basics, in my opinion.
Yeah, I mean, Dave, besides for bringing it all down, what else is on the drawing board, right? I mean, I think a lot of people mention term limits for politicians in Congress, et cetera, just like getting some reshuffle of the humans involved, because they just kind of continue to amass some power over time. But like, what else do you see could be done? Next year's an election year, right? I think Bitcoin and crypto is going to be very much front and center in the middle of this like political debate. Yeah. What are your thoughts on all those?
Well, look, yeah, I think term limits would be a great thing. I think rank order voting would be a good thing. Michael Porter has laid out a very strong case for that. You know, I think that getting the money out of politics would be a good thing. I mean, I hope that, look, the monetary thing, I mean, I've been saying that I think there's a significant non-zero risk that we will ultimately have hyperinflation in America in the reserve currency, which I know most people think I'm nuts and most people think I'm a doomer to say it, but to me, it's just mathematics. I think it's probably a 10-year out kind of time thing, but, you know, perhaps the inflation will get hard enough or big enough that people will decide, you know what, we're going to do a monetary reset the way Roosevelt did in the 30s. You know, perhaps we'll get a better set of politicians as everyone gets fed up here. I hate all politicians in general, but I do kind of rank order them, and you know, I find RFK to be somewhat of a breath of fresh air. He's flawed in many ways. I don't agree with him on a lot of things, but I actually, of the three major candidates that are now out there, I trust him more than the other two. And so, you know, to the degree that the country leans in a trend towards backing more trustworthy people, more trustworthy, honest people, I think it's possible that we'll vote our way out of it. But I wouldn't say, I'm not counting on that. I actually think the monetary events are going to outrun the political events, and create some conditions, and maybe then it's what is it Churchill said, Americans always do the right thing after they try everything else. Yeah.
So I know that you've been talking really just about America.
Yeah.
And I understand that you're not necessarily a macro.
I'm not.
But your call is a bit macro, right?
Yeah.
What do you think about international investing? Because under the scenario that you're talking about, you certainly wouldn't be investing in Europe.
No, I wouldn't touch Europe. I think they've got all the problems that we've got. I mean, it's difficult because, you know, there still is probably the best rule of law in America, as flawed as we are. It's interesting. I know Michael earlier today tweeted something on Brazil, and I've got a good friend from Brazil, Tavi Costa, who actually did a really nice chart and showed how cheap Brazil is. I mean, let me say this, if I were to be investing in stocks anywhere in the world, I would be focused on commodity stocks, because I think we are in an inflationary commodity cycle. And if you want to pick a country that's heavily focused on commodity stocks, Brazil is your country. So I would think I would be taking a hard look at that. But there are other countries with a commodity focus. It's difficult. I mean, you know, picking equities is difficult. I mean, let me say this. To me, the biggest no-brainer investment in the world right now that I own, I mean, of my risk capital, I have about 50% of it in Bitcoin. I have about 50% of it in gold, silver, and gold and silver mining companies. Okay, I don't have anything in Brazil or anywhere else. And the reason is the asymmetry in those bets. And to me, the biggest of those bets, the one that's the biggest no-brainer, in my opinion, is Bitcoin. And I'll tell you why. There's no management team. And I love that. I mean, as you guys know, if any stockbroker will tell you, what's the hardest thing to figure out about picking a stock is, do these people really know what they're doing? Because I can't tell you how many times they disappoint you. You know, it's like every single stock. They can have it all teed up perfectly. It ought to be a home run, and they will F it up every time. Not every time, but lots of times. And so here you got this thing, this Bitcoin thing, which is you got two things going on. It reminds me of the internet. You got two things going on. You've got sound money being important, more important because monetary debasement's occurring at the government level. And then you've got an adoption curve, which is to say there are 8 billion people and maybe 100 million have Bitcoin. I don't know the exact number, but it's small. But it's growing. And so you've got more and more people coming to see the value of it. And then you've got something that's never existed before. You've got a commodity with a fixed supply. So this is a really different animal. Every other commodity in the world, gold, silver, corn, oil, whatever, take the price up a lot, you'll find more of it. We're ingenious folks. We will find more coal if the price of coal goes up 10x. The price of Bitcoin goes up 10x, doesn't matter. The supply is what it is. And so, that, I don't think most people have really got their heads around that yet. And that's why I've never seen anything like this thing. I mean, it's so asymmetric, and I'm sure there are people who listen to this and think, this guy's absolutely crazy, okay? But I have little doubt that Bitcoin will be worth 100,000 within a few years and $1 million within 5 years and more than that within 10 years. I mean, I have very low doubt on that. So if that's the case and you can buy one today for 35,000, it's kind of like, huh? Okay, so I should go over here and buy a company in Brazil that I don't know the management. I don't know what the Brazilian government's going to do in terms of taxes. I don't know what the commodity they sell, what the price of that commodity is going to do. I mean, there are a lot of I don't knows there. Yet I know that every 10 minutes, another block of Bitcoin will be spit out. And I know that every year, 20 or 30% more people use it. And I know that, there's a limited supply of it. It's like, gosh, that strikes me as a pretty easy way to save for your future. And so, when I'm talking to my clients, I have a lot of clients who are gold only who don't like Bitcoin. I had some people leave me when I told them I was doing a little Bitcoin in my fund. And I said, you're really missing it here. You don't need to put all your money into Bitcoin. I would never suggest that. Never. It's very volatile, but to have zero Bitcoin is really the wrong answer because this has a lot of upside optionality. And that's what I just want to emphasize that.
I'm just curious real quick, were you always a Bitcoin believer or did you have
that's an excellent
now?
Yeah, so that's a great question, Cynthia. So I heard about it in 09 and 10 because I was involved with Ron Paul and all the Ron Paul servers. They were buying it. I know people bought it $1, $2. I know a secretary bought a couple hundred, like 500 of them at like $2, right? She still has them, right? Do the math, okay? It's a really great story. And I didn't buy them back then because they were hard to buy. You had to go to a cafe, give somebody some money. Somebody had to be mining them. They give you a paper wallet, blah, blah, blah. I waited until Coinbase came out. And I bought my first ones at about 300. And, the skepticism I shared is the same one that Lynn Allen shared. She talks about it in her book, her excellent book, by the way, which is I just thought, how can you have money on a computer? It had been tried, by the way, in the 80s and 90s. There's a whole etymology of Bitcoin. You can go back and see, there was Cash Coin. There were all these other coins. How can you really have money on a computer? I mean, we all know computers crash, right? I mean, if you had IBM PCs back in the day, they'd go blue screen on you, right? And it's kind of like, you can't have money on that. The thing's going to blow up, right? And so I didn't understand blockchain. I didn't understand hashing. I didn't understand the nonce. I didn't understand the difficulty adjustment. I didn't understand any of that stuff. And so it took me, and I went to an MIT Bitcoin meetup group in the 2014 timeframe. I sat next to a core developer and I said, do you ever worry about the thing? He said, yeah, sometimes I make a change. I go home at night and I think I've croaked the whole network. And I was like, good God, here's a guy who, this guy's a PhD computer scientist and he's worried about it, right? So, how can I really have money with it? And so, of course, then we went through the block wars and then there were some back doors that got plugged, fortunately, but there were a lot of risks in the earlier days that it wouldn't make it. And that my fear was a legitimate fear. We've now got 15 years, 800 plus thousand blocks, a lot of core development work, a lot of technology work. I don't think the risk of Bitcoin failing is zero because it's a computer network system, but I think it's extremely low, like less than 0.5%. So my holdings of Bitcoin kind of continually increased as my confidence in the technology continually increased. And I didn't get thrown off the bowl because I was buying at 300, I was buying at 400, I was buying at 1,000, I was buying at 5,000. And you might recall in 2017, there was a big run up. Everyone was talking about it at Thanksgiving. It went up to 17 grand. I was buying it. I bought a bunch of them at 17 grand. Oh yeah, I got to get a ton. Well, it quickly turned around, went back to 10. So I doubled down. Then it turned around and went from 10 down to 3.5. And I didn't get the 3.5, but I bought like at 3.9. I doubled down again. And so, I just kind of kept buying because I thought to myself, I think this thing is right. And I wasn't measuring its value based on its price. I always measured its value based on adoption because it reminded me so much of the internet. Are more and more people using, I was looking at two things. There were only two things I focused on. is this thing technically sound? I.e., is it going to blow up? Does it work? And are more and more people using it over time? And as long as I maintain confidence in those two things, yeah, I'm good. I know it's going to be worth a lot of money. So that's kind of how I went through it, you know?
So I too have a friend from Brazil, by the way.
Yeah.
Cynthia. So, you know, to your point, actually, let's see, I'm looking at some statistics and there's something like 431 million crypto users.
Oh, is that?
Okay. Yeah, that's like 5% of the population.
Okay.
And 63% are male and 37% are women. I can't validate these stats, but I can source them. It's 21.co is the source. So what we really need, and Cynthia, you can comment on this, we need the women to come in and adopt Bitcoin.
I think it's called that risk aversion we're known for as a group. So, but I mean, I bought Bitcoin, as everybody know, like I think 2 years ago for the first time. It was a very rocky road. We have not had a great relationship. I think I bought at the peak and faced a lot of pain. And so I'm always curious about people's journey into the space.
Yeah, I mean, I highly recommend dollar cost averaging. And, you know, shameless plug here because I'm involved in a project with them. I do it at Swan. I think they're great folks, Swan Bitcoin. It's just, you know, anyone who start, even if the math is interesting. If you bought your first coin at 65,000 at the peak and you DCA'd that amount of purchase from then until now, you're ahead now because you captured all that $15,000 stuff, you know, I don't know, 6 months, a year ago. So you got to DCA it over time because it is volatile. There's no doubt. And you got to have a time frame. I mean, I think, Michael, you deal with this a lot on your Twitter feed and other things. I mean, it's all about cycles and time frame. I mean, I'm not smart enough to be a trader. I'm not smart enough to think in days, weeks, even months. I mean, I want to get stuff that has a tailwind behind me. And, you know, I mean, yeah, I trade in the sense that if I see something that's really cheap, you know, Mr. Market gives me an opportunity. I like the thing and it goes down a lot. I'm like, oh, I still like it. I'll buy it. But I'm not looking to flip trade stuff. I'm kind of looking longer term.
What do you think is harder, tactical trading or raising assets? Because I got to tell you, in our business, people really don't appreciate just how difficult it is to raise assets for products that you believe in, independent, by the way, of whether you have strong performance or not. It's still really challenging.
Oh yeah, they're both extremely challenging. I mean, I haven't really tried tactical trading that much, so you know, I can't really comment on that. I know raising assets is tough. I mean, as I'm sure you guys are aware, this happens in your business, happened in my business. I mean, I was pounding the table in 2016, 17, 18 about the gold stocks, how cheap they were. You know, my fund went up 4x in 2019 and 2020, so 400% appreciation. A ton of people joined me, right? They looked at that number and said, oh my God, this is great. I got to get in on this. Okay. Typical. And to be totally fair, I went down 50%. I gave half of that back from the peak of 2020 to right now. Now, having said that, right now I'm on a drawdown and I'm pounding the table again. But, you know, if you go look at the charts of the gold, you know, you look at what's happening in the junior gold stock people, and you look at my existing investors, many of whom are very angry and frustrated, you know, raising money in these conditions. I mean, sadly, people are kind of wired to do the wrong thing, which is to chase momentum and buy late and at the peak. And then of course they which can be okay if you've got a long-term trend, but then sadly, then they also sometimes, I had one guy who, you know, who puked it out at the bottom, right? I mean, he bought a ton at the peak and he said, I'm disgusted with this shit. I'm selling it all. And I said, well, if you wait a couple of years, you might be, you know, much happier with it and you wouldn't take a loss. But he said, no, I'm done. So, you know, it's hard. I mean, it's, you know, investing, you got to fight your emotions, right? And you got to take a multi-year perspective. I mean, I have a lot of admiration for a guy like Bill Miller who, you know, bought Amazon in the early days and held it through 3 or 4 50% drawdowns. You know, you could see what it was, and you know, he hung in there. And that's part of the longer term value investing game. I mean, Buffett's done that reasonably well too in a number of cases. So
I
Good.
I credit Michael Saylor for doing exactly what you're talking about, right? He's been a buyer at 35, 40, and also a buyer at 15. And it's a lot harder, to your point, to buy at 15, especially when you're diluting yourself, right? Where he's issuing shares to do it,
Absolutely. Yeah, no, it's funny though. You look at those notes when they were coming due and you look at it when it was 15, and I've noticed in his videos, he seems a lot happier today than he did when it was at 15. He seemed a little bit more relaxed. I mean, there had to be some point in time in there where he was thinking to himself, I got these notes coming due and, I'm underwater on this stuff, but I've met him. He's a good guy. I have a lot of respect for him. I appreciate his approach, which I think actually engineers can make really very, very good investors, people with engineering backgrounds. Lynn Alden qualifies, he qualifies, because it's kind of a systems problem. It's an understanding how things work problem.
Well, in the case of Bitcoin too, it's math, right? I mean,
yeah, it really is.
Appreciate that.
Yeah,
Sorry.
it really.
No, exactly. And everybody again that's watching, please make sure you hit that subscribe button. Lawrence, for those who want to track more of your thoughts and work outside of the gym, because I know you're big on CrossFit, right?
Yeah, I am. I'm not that good an athlete though. I just show up every day. So my thoughts and work. I'm on Twitter at Lawrence Lepard, is just my name. Then I have a website, ema2.com, Edward Mark Alpha, the number 2.com. Publish a quarterly letter. It's free. We won't spam you if you get on our email list. I put up macro stuff, put up videos. My biggest, the reason I do all of this, I mean, I do it obviously for my investors. I do it to try and, protect our capital, but I also do it because I do believe that, this goes to the doom comment. I do believe that while there are some tough things coming, the sooner and more aggressively we adopt a return to sound money, the better we'll all be. The better the society will be, the better the economy will be, the better everything will be. The war, you name it. Look at any problem that's going on in society today, and I think given enough time, I could convince you that unsound money has played a role in it. And so if we return to a sound money standard, I remember very much what the country was like in the 60s and 70s. This is a different country. This is not the country I grew up in, sadly. And you probably remember as well, right? I mean, it was, there was a real middle class. People were kind and generous. I mean, it was a different place. And it wasn't all about a money grab. Politicians were, they were corrupt, but they weren't just getting rich like these guys are. I mean, it was a better place. And, at 71, when we broke the gold peg, that was the beginning of the downfall, and it just keeps getting worse. So that's my view.
Everybody, please make sure you follow Mr. Lepard. I see Mr. Chikansky wants to do a closing question. So go ahead, Dave.
I was just going to say, so April 23rd, 2020 was the day that we announced the $485 billion COVID relief package. And the next day was the end of the bull market in Treasury bonds. So it's very funny that it was a literal specific reaction to that ended that 40-year period.
It doesn't shock me. I mean, Treasury bonds are a bad place to be. I mean, we're going to get a rally here, as we all know, for a while. But, I would fade it over time, because I don't think they're a good place to be. The government is manifestly bankrupt, sadly.
But thankfully, the intellectual rigor of our conversation is not bankrupt. So everybody, make sure you follow Lawrence. Yeah, I don't exactly. Everybody, please make sure you follow Lawrence, and obviously click subscribe on the YouTube channel. And hopefully, we'll see you on the next episode of Get Think Tanked. Thank you, everybody.